Good day, everyone. Welcome to another edition of Strategic Financial Management. In today's class, uh, we shall continue with our class on free cash flow. Right? In summary of our last lecture, that is that free cash flow it is what is available to the company or to the firm after deduction of all essential items, right? And that is why it is called free, because the management, by its discretion, they can use it to invest, right? Or use it to reinvest into the business, right? Depends on what the management what decision. And I said that free cash flow is divided into two. There is free cash flow to the firm, and there is free cash flow to equity. I've mentioned in our previous lecture that free cash flow to the firm or free cash flow to the equity are all form of valuation of the business, right? As we move on, we will see more of free cash flow, right? Now, free cash flow to the firm is like the cash flow available to the company suppliers of capital after deduction of all operational expenses, working capital, non-current asset, and replacement of what? Replacement of an asset, right? What is available to those who contribute capital to the business? It is what we call what? Free cash flow to the firm, right? And it is calculated as the profit after tax, right? You add back the non-current assets, non-cash flow, right? After that, you take you take amortization, you add back your amortization, your impairment, right? Your net will be the net of the your interest will be the net, which I've explained yesterday, right? Then increase will actually do what? Will reduce your cash flow. Then decrease will increase your cash flow. Likewise, non-current assets, is a cash flow, right? Increase in non-current assets will reduce your cash flow. Reduction in a non-current asset will decrease your what? Reduction in a non-current asset will do what? Will increase your what? Your cash flow. Likewise, we have a working capital where increase we do what? We decrease your cash flow because it is what you use in running the business. Why decrease we increase your cash flow, which means that you don't spend enough money to finance the business, right? So what you will have, it is called free cash flow to the firm, right? Now, it is now available for the company to say, oh, this is the free cash flow available for the firm. What should we use it for? Should we use it for investment, or we pay those who contribute capital, right? Now, what are you going to use to discount it? You use weighted average cost of capital because you want to get, the question is, oh, what would be the current value of this so company, right? When you are talking about the current value, you are talking about valuation. You want to know the value, right? You want to know the value of the business. You use the weighted average cost of capital to discount it because it is free cash flow to the firm, right? Now that is the reason why you have to use what? The weighted average cost of capital. And don't forget, your changes in working capital or your working capital is what you use in running the business, right? Which is the current asset minus what? Minus current liability. Current asset excluding cash, right? Cash, while current liability excludes short-term debt or anything that has to do with dividend payable. It is not part of your what? Current liability. You exclude it, right? Which we've already explained in our previous lecture. Now, having done that, we move to free cash flow to equity, right? In our previous lecture, we were able to explain free cash flow to equity, and the question now is, what is free cash flow to equity? It is the cash flow available to who? To the investors after deduction of all essential items, right? After deduction of non-current assets, your taxes, of course, you pay taxes, right? Non-current assets, working capital as well. Of course, you have to pay your debt, which is borrowing, right? That is why we have here increase slash decrease in borrowing. Of course, don't forget, under the cost of capital, you need to pay your debt holder for. So what is available after you make this payment? It is what we call free cash flow to equity. right? So it is now the company dividend policy that, oh, this is the free cash flow to the equity. We are paying dividend of 15 naira per shares. We are paying this. We are investing this, and so on and so forth, right? So the question now is, what will you use to discount it? You use the cost of equity to discount it to get the current value of what? To get the current value of the business. You use what? The cost of equity to get the current value of equity, and this is what we explained in our previous lecture, right, which is yesterday. Now we're looking at this question. Oh, okay, I've actually had business valuation. That will be immediately after this class. Valuation of a business. Sorry, I'm coming. Okay, now we're able to look at this question, right? And the question says that we should determine, we should use calculate the free cash flow available to equity for the year ended July 2024, right? 31st, 2024, right? Which we started with profit after tax. Then after the profit after tax, according to our format, we add back depreciation. Now, when you look at depreciation, where did we get our depreciation from? Depreciation is in your income statement, right? Which is this, right? Then, after that, we need to move to non-current assets, right? We need to do what? Check if there is increase or decrease in what? In non-current assets. Now, since we're given 2 years, now we now look at it that as an analyst, you have 2023, you have 55,942. In 2024, the non-current asset increases. So it could be that, oh, they bought a new asset in 2024, and that is what make it to decrease, or to increase, right? And don't forget that this your 224 naira is what? Is the carrying amount of an asset, which means that they would have taken into consideration of what? Of depreciation, right? And that is why we need to take it back to the current cost of the asset, because we want to determine either the asset increases nor decreases. Look at it. In 2023, we have this. In 2024, we have this. So now we have to add back this depreciation so that we have the real cost of the asset. So when you have the real cost of the asset, you will now look at it. In 2023 is what? 5,942,000. Why in 2024, what do you have? You can see that the asset has increased. The question is, what is the increase? The increase is the difference between 6,664 minus 5,942 will give you your increase in the non-current asset. Now, when your non-current asset is increasing, what does this indicate, class? It indicates that there is a cash outflow which will flow out of the business, and that is why we have to put it on jacket. We have to put it in what? In bracket. And this is where we stop in our what? In our previous what? Lecture. Class, am I communicating? Am I communicating, please? Now,
Yes, sir.
thank you.
Yes, sir.
Thank you. Now, if this is well established, right? If this is established, we move, right? Don't forget, from the formula, we have profit after tax. You add back non-cash item, right? Increase slash decrease in non-current asset. The next thing is working capital if there is a replacement of an asset. Now, from the question we read, there is no replacement of an asset. If there is a replacement of an asset, it would have been mentioned in the additional information, right? Now, the next thing we need to look at is what? Working capital, class. Working capital, please pay attention. Please, we've started. Please pay attention. Working capital. So let's quickly check. I think we started it yesterday as well. Okay, yes, I think so. So don't forget, your working capital will be your current asset minus your current liability, right? So now we quickly go and check what make up our current asset. Then we copy it down. What make up our current what liability? Don't forget, your current asset exclude cash and bank, cash and bank, class, cash and bank, class. So the only thing we need to copy here is just this as part of our what? As part of our current assets, right? Because we want to know the changes in what? In working capital. So we need to copy this as part of our what? non-current what? Non-current assets. So we move down, we check. Where is it? Okay, this is it, right? So this is it, right? Clement,
Sir, please, why are we excluding cash and bank?
it is assumed that you didn't use it to run the business. You already have it before, right? It is not part of the finance of the business.
Okay, sir. Thank you, sir.
Yeah, you're welcome. So, the receivable, that is a very good question. Well done. The receivable for this is 980 for this year. Coming. I think I need to delete this. Okay, I'm coming. Clement, Clement, are you still there?
Yes, sir.
Do you understand why we have to exclude it?
Yeah, you said because it's not used to run the business.
What other things do you think could have been why we exclude it? Inventory.
I don't even know. That's why I asked the question.
Okay, that's fine. Inventory. Okay, we need to check. We need to check back our inventory. Let's check the figure given to us. Please, if you want to ask question, wait till the end of this part, please. Thank you. Please. So inventory. So we go back and check the inventory. So this is our inventory, right? Wish I can just copy this without the table. Uh, coming. Inventory. Okay, I know it will scatter. So 2542, right? This is 2078. So this is our inventory, right? So the next is to bring in our current liability, right? To bring in our current liability, we need to check. Don't forget, our current liability exclude the short term, anything that has to do with overdraft, right? Overdraft, right? So now let's go back to current liability. Where is current liability? Okay, short-term loans. Don't forget that it excludes short-term loans. I think someone was raising his around. Fridaus. Is it Fridaus or Mohammed? Something like that. I think someone was raising his around. Who is that? Okay, okay, that's fine. Okay. So we have to copy this, right? Just this part. Okay, coming. Working capital. Working capital. Okay. So accounts payable, right? Accounts payable, payables. 3,084, 2,792. Okay, so what is our working capital? What is the difference? Don't forget that, class. Let me quickly take you back to the financial statements, right? Let me quickly take you back to the financial statement. Can you see it? What did you see under the current liability? What did you see under the current liability, class? Are we still together, please? Hello?
Yes, sir.
Okay.
Short-term loan,
Yes, short-term loans, right? It is for short-term loans, right? So,
account
the
payable.
accounts payables, thank you. And when you look at the short-term loan, it's just for a short period of time. And it doesn't part of what you use in running the business because it is for a short period of time. And when you are talking about account payables, don't forget that account payables are your suppliers who supply you raw materials on a daily basis. You can't do without them. Is that not so? And you may purchase a raw materials on credit from these people. It is what you use in running the business, right? Right? It is what you use in running the business. So your current assets exclude cash and cash equivalents because you already have it is not part of what you use in running the business, right? You have it already, right? Then the current liability, right, exclude the short-term loans, maybe an overdraft. For instance, this short-term loan could be an overdraft, right? And overdraft is just for a short period of time, right? It doesn't form part of what you use in running the business. How long is it going to sustain you to run a business? But your account payable is very important to you. Do you know why? Because these are the people who supply you raw materials on a daily basis. You can't do without them. If not, your business will just what will shut down, right? And that is why we have to do it that way. Clementina, do you get that? Clement, sorry.
Yes, sir.
Okay, okay, okay. Don't worry, I will still explain. You see, is it not working capital? You will see more of this. Don't worry. We'll still explain more about it. So please, the current asset minus current liability, what do you have? Quickly, minus it quickly. I expect you to be with your calculator, right? So just give me figure. What is the working capital so that we can move on, please? Uh, you put this in jackets. Where is Olanike?
I'm here.
Ah, give me figure.
264.
Okay, I'm coming. I'm coming. Just please, if you are not giving me figure, just mute your mic, please. Just mute. Okay, quickly. What do you have here? Alanike. Okay, Rachel.
530.
Okay, 5:30. Okay, what do I have here?
260.
Okay, two, two what?
260.
260. Rachel, can you be audible enough, please? This is your bedroom voice.
266.
266, right?
260, sir, is correct.
Okay. That's fine. So now, class, now let's check. Let's check. What is the difference? You can see that. Please mute your mic, please. You can see what happened here. Can you see it? What happened here is that in 2023, the working capital was 260. In 2024, the working capital increased to 530. So what is the changes? What is the increase in working capital? Because there is an increase, right? Increase in working capital. The difference, class. What is the increase in the working capital, class?
264.
Okay, 264. Thank you. Now, can you see it? You can see the way we are breaking it down. And this is how it works. I'm just doing it this way is because this is the first lecture on free cash flow, right? When we get to merger and acquisition, you see more of this, right? We'll get there. Very simple. Now, in this case now, can you see that there is an increase? Olanike,
The second value is 266, not 260.
okay, that's fine. So just make use of the chat button. If Okay, so the difference is 264. Okay, that's fine. That's fine. So we move on, right? So there's an increase. We all agree that this is an increase, right? We all agree that this is an increase in what? In working capital. So we go back to this table, right? Then we now have increase in working capital, right? To be 264. 264. It will reduce your cash flow, right? Now, do you have any other information that has to do with maybe increase? We don't have anything that has to do with replacement of an asset, right? So therefore, we need to close it, right? Based on our format, we don't have anything, right? Let me quickly show you again for those of us, for those of you who did not check the YouTube. Where is it? Okay, can you see it? This is free cash flow, right? Free cash flow to equity. Now, we still have, under the free cash flow to equity, don't forget, we still have borrowing. You can see, we've forgotten that borrowing. That is when we want, yesterday we want to use free cash flow for the firm, for the equity, right? You can see we forgot this again today. Increase like decrease in total borrowing. I've stated the reason why we have to add the borrowing, right, in our previous lecture. Because this is free cash flow to equity. You have to pay your debt holder class. Now, and what is left, what is available, that is what is available to the what? To the investors, right? That is what is available to what? Investors. So you have your borrowing now, right? So now, let's check. We have to go back to the financials to check our borrowings. Don't forget, borrowings, based on the format, I say total borrowings, right? Your total what? Your total borrowings, right? Now, in this case now, your total borrowings, both your current assets for borrowing, the money you borrow under the current liability, sorry, current liability and what? Non-current liability will be your borrowing. Your current liability, what did you borrow? Your short-term loans, is that also debt, borrowing, debt, borrowing, debt? Non-current liability, can you see it, class? Can you see what you borrow? Your current liability is loan. Can you see it, class? Are you still there? Borrowing.
Yes, sir.
Non-current liability again, borrowing. All your total borrowing, the money you borrowed, right? The money you do what? You borrow, right? So we need to check, is there any increase in borrowing or there is a decrease in what? In borrowing. And don't forget, I think we actually made a little error there yesterday, right? Because it is opposite. Class, let me tell you something. Someone gave me maybe borrow me next gen, maybe someone borrow next gen professional 50,000 naira today, right? That 50,000 naira will form part of our inflow and it will be added to our cash in, it will increase our cash flow. Is that not so? Someone give you money now, just like someone give you money to finance a business, give you 50,000 naira, maybe Rachel, 50,000 naira. It will add to your inflow now. Is that not so? And do we analyze it that way in our previous lecture? I guess no. Class is the opposite. When you have an increase in borrowing, it will increase your cash flow. Let me quickly correct that. It will increase what you have, right? The person credits you now. Maybe you want to borrow 250,000. The person now credits you now. What will happen to your cash inflow? Is it not going to increase? It will, okay, yes, yes, yes. I've changed it. It will increase. Your cash inflow will do what? Will increase. Is that not so? And when you don't have enough money to finance the business, how will you expect your cash flow to increase? It will decrease, right? And that is why it is like that. So in this case, let me quickly go to the financials and copy the total what? The debt. The debt. Okay. So we move to borrowing, which is debt, right? So please always show your workings, right? Borrowings. Debt, right? Um, so it's for how many years? Let's say 2 years. I'm coming. Can just copy this. Okay, I have enough questions on valuation of a business. Immediately after this class, we'll move to valuation. We'll move to valuation of a business. Okay, borrowing. Okay. Sorry, my apologies. I will send the material tonight, immediately after this class. I think I still have one question to add. I have to check. to check. Okay. So the borrowing, quickly, these are the borrowings, right? The long-term debt, let me just use long-term debt or non-current asset, right? Because of this is on table. Okay. Okay, you will understand this way now. So you know this is for 20. Okay, you can still arrange it then. So this is for 2024 and this is for 2023 class. So now add everything together. Let's check if there will be increase or decrease. So let's check. Add your total of 2023. Add your total of 2024. What do you have? Quickly, we want to test for increase slash decrease in what? Payable. In debt. Are we still together?
Yes, sir.
Hello? Okay.
2023.
Okay, that's fine. Oh yeah, add. Figure.
Two, no, the 2023, 3932.
Good.
3932.
3932. Please, where is Pemisire? Are you still in this class?
The other, the
4336 for 2024.
Okay, 4336. Please mute your mic immediately. You give me figure, please. Thank you. So we need to check, class. Is there any increase in borrowing or decrease in borrowing? What do we have here? Increase in borrowing, right?
Yes.
increase of 4.
404.
Increase in borrowing. Increase in borrowing is the difference, so because I know someone will still ask, how did I get that difference? Increase in borrowing, right? So what is the increase? Figure. What is the increase? What is the increase, class?
40.
404.
Okay, 404. Pemisire, are you still in this class?
Yes, I am.
Okay, good. 404, right? Okay. Don't forget it's a million, right? A million. So, class, there is an increase. It will increase your cash flow, right? So we go back and check. We go back, 404, increase, increase in borrowing. So 404. From our format, I think this is all on it, right? If you check, we don't have any other information that has to do with any other thing. Don't forget, you add your non-cash item, any increase or decrease, your working capital, your borrowing, right? And this is all what we have. So now let's check what is our free cash flow to equity. What is free cash flow to equity? Quickly give me the figure. What is the free cash flow to equity? Um, Ebubechuku, right? Ebubechuku. Ebubechuku, go ahead. Okay.
Good evening, sir.
Good evening.
Okay, please, is there any specific reason why accounts payable is not under total borrowings? Like it's not considered. Why?
No, it's not considered. Did you borrow the money? Did you borrow it?
It was lent to you on credit, or
You say
you borrowed.
you didn't borrow it. It is part of working capital you use to finance the business. Without your suppliers, the business cannot stand. Is that not so? We are talking about we are talking about the money you borrowed that there is an obligation that you will
Oh,
pay back. Don't forget, under
okay,
the
okay,
cost
sir.
of capital, do you get? We are talking about obligation. Obligation. You collect bank loan now. before once money just drop like this, you will see they will remove their loan down. There's an obligation there. You must pay back. Do you get it?
Yeah.
Do you get?
Yes, sir. Thank you,
Okay.
sir.
Yeah, you're welcome. So now let's continue. So what do we have quickly? Figure. What do we have? What do we have? Quickly, what do we
nine
have here?
912.
Okay, 912. Confirm. So this is, please don't abbreviate to write it. Free cash flow to equity. Because they say it's for 2023. We're supposed to say free cash flow, or you say computation of free cash flow to equity for the year ended. That is what we're supposed to do. Please, these headings are very important, right? Please, you can say computation of free cash flow to equity for the year ended July 31st, 2024. Right. So okay. Benjamin, I'm coming on. I need to finalize this part before we move. Do you know why I can welcome questions now? Because this is the first class, right? So as we move forward again, I expect that you should have been familiar with the terms, right? Okay. So the question says, I'm coming, Benjamin. The question says that calculate the free cash flow available to equity. That is all. Oh. This is the free cash flow available to what? Equity. A. This is what? Free cash flow available to what? Equity. Right? This is free cash flow available to what? Equity, right? And this is all about it. A. Don't forget this question, I think they added one thing in one diet. Yes, it was tested in one diet like that. They added C. Think advantages and disadvantages of stock exchange listing. Yes, I remember. Yes, they added that advantages and disadvantages. I think it was 20 marks question. Yeah. Benjamin, quickly, please, quickly, before we move to B, quickly. Unmute your mic
Okay,
quickly.
so sir, thank you very much. I understand this increase in total borrowings, why it is not jacketed, because it's an inflow to the firm, so it increases their cash flow. But I really want to understand the rationale why that of increase in working capital was jacketed.
There
Yeah.
is an increase. Um, Benjamin. Okay, I will tell you the reason why there is an increase. Practical, so that it will stick. I use 100,000 naira to start the next gen at the beginning of January 2025, right? Then, then, it is not my money. Yeah, it is not the company money, right? Now, what is it called? Let's say personal to start a business 100,000. So on a year-on-year basis or on a week-on-week basis, that money that I use to start the business, that working capital, right, is increasing. Don't forget that as this money increases, what will happen to my cash flow? My cash flow will decrease because I will receive some cash from people, right? I'm using this working capital to pay my suppliers, my debtors. I will pay them. Is that not so? So as you are paying these people, will the cash still remain with you? No, Benjamin. It will reduce your cash flow. Are we still together, please? Do you get? You see, I will use simple language. You see, it will stick. You don't need to carry textbook or anything. Just understand. Do you get? So we are good now. We are good. We are good. I want to be sure that we are good to go. Are we good to go, class? Are we good to go? Please. I need to
Yes,
confirm that.
sir.
Okay, okay, okay. That's fine. That's fine. That's fine. So if this is established, the next question is using free cash flow to the equity. Sorry, I need to plug my system. A minute, please. Okay, I'm back. So it is what it is, right? Using free cash flow to equity model, calculate the current value. Class, I've said it several times. Why do you have to use, why free cash flow first? Why free cash flow? I've mentioned this several times. Free cash flow is a form of valuation of a business. As an equity investor, you want to buy shares in the market, right? What is the current value of the shares? Now that will take us to one of the bank financials, probably JITCO. You go to NGS today, what will be the current value? That is the market price. And that is the reason why you do valuation. You want to get what is the value of this business? Yes. Now, as an investor, okay, this is the value of the business. Oh, if I buy these shares okay, if I buy these shares at now, the current share price maybe is at 24 naira per shares. It is 24 naira per shares. What if in the next 2 weeks, will these shares increase by 50%? That is why you do valuation, right? That is why you do valuation of a business. You look at it, okay, I can buy the shares, right? Free cash flow is a what? It's another method of valuation. And that is what the big part of this question is saying. That what will be the value, the current value per shares, right? Now, let's quickly go back to the question. The additional information. The following additional facts are available. The director, what happened to them? The directors believe that the free cash flow to equity model should provide an appropriate valuation of the company's shares. Is that also of the what? Of the company's shares. And investment bankers has provided the following estimates of cost of what? Capital. We have the cost of equity. We have the post-tax cost of debt, 4%. We have the WACC of 12.5%. Don't forget, this is free cash flow to equity. You use the cost of equity to discount to get the value, right? Now, the directors believe that the free cash flow to equity will grow. Class, what you just calculate now, your 912 will grow by 18% for the next 5 years, class. That's your 912 will grow by, because you want to get the value. Don't forget, present value. What will be the value? And the directors now believe that, oh, this thing will grow by 18% for the next 5 years. So we need to grow your equity, your free cash flow to equity by 18% for the next 5 years. Then what next? And by 5% thereafter. See, thereafter is infinity. Class, thereafter, 5% thereafter. Did they put years? Did they say 10 years? Did they say 6 years? It's infinity. And there is a formula for that. So firstly, we need to grow the free cash flow to equity by 18% because we need to get the value, right? We need to get the value. So we want to get the present value. We need to grow it for the next 5 years. Then we will now calculate infinity, and by 5% thereafter, no ending. That is infinity, from 5 to infinity. Class, am I communicating, please? Am I communicating?
Yes, sir.
Okay, now let's move on. So if this is established, class, so let's quickly move on. We need to grow B, part of this question, by 18% in the next 5 years. B, oh, this call will end in. Then I need to check. I need to confirm. Favor, please, when it is 3 minutes to end this call, please let me know so we can create another link. Thank you. Now, what will you do? Because it will increase. There will be a growth in it for the next 5 years. Class, if the free cash flow to equity 918, you grow it by 18%, right? In the first year, you need to get the present value of it, because first year you grow it, what is the present value? Second year you grow it, what is the present value? Third year you grow it, what is the present value? Fourth year and what? And fifth years. Now let's go there. So we have the numbers of years, right? We have the years. We have the years, right? Then after years, we have the items. So we have the cash flow. Cash flow. Don't forget, what will you use to discount it? This is free cash flow to equity, DCF. Don't forget the DCF, you use the cost of equity. What is the cost of equity here? Is 15%. Class, is what? Is 15%. Right? So when you are growing it, you need to get the present value as well. So PV, class. So we're told that the free cash flow to equity will grow by 18% year one. The free cash flow, I want to abbreviate, please. Or you can say cash flow, or you say free cash flow. Anyone. Cash flow. So is a million. Sorry, I need to bring in this million. We need to arrange our work so that it will look neat. Okay. I know some of you did not understand what I'm doing, but just observe. Observe. You must understand, and you must pass. You must pass. So tell your village people, tell them that this time around you must pass. So the cash flow is 912, right? And don't forget, this cash flow will grow. Let me quickly go back to where they mentioned it so that everybody will be seeing it like this. The director believed that the free cash flow to equity, that is, we grow by what? 18%. When something is growing by 18% on year basis, is that not so? What will be the present value of each of the year? You cannot just grow it. You cannot just grow it and leave it. You have to discount it. What is the present value? Right? So in this case, this will increase by 18% times 1.18 raised to power what? Raised to power 1. Raised to power 1. Okay, so what is the DCF for year 1? Please, someone should give me the DCF for year 1. Your normal DCF will 15%.
0.870.
Please, if you don't know how to do DCF, you better don't shy. Why shall I shy? Just tell me now so that I will show you how to determine DCF. Oh. 0 point, and I told you that you should leave it in 3 decimal place, right? Don't forget, I've mentioned it. I said 3 decimal, 3 decimal, right? So what do we have? 9
0.870.
70.
870, yes.
Is it 70 or 67? Which one?
69, but 695. So it is now 870.
0.8.
70.
No, wait. Olanike, give me the full figure. 0. What?
8695.
95. 8695. Okay. So we can have. Okay. We can have 70 then. So what is the PV? What is the PV? What is the PV?
936.26.
936
Point
point
two
what?
six. 26.
Point.
I'm coming. Please confirm this figure. 912 times 1.18 times 0.87. 870. What do you have?
936.26.
93
6. Point.
936
Yes, 0.26.
2 what? 22, right?
26.
Okay, 26. So we can leave it. We can just leave it 936. Let's leave it one thing. Let's round it up. Let's just leave it 936 and move on. Okay, the call will end in 3 minutes. Oh, 2 minutes. Okay, that's fine. So let's quickly. So in this case, we need to move to year 2, right? Year 2, you have the same cash flow. You have the same cash flow. Then this raised to power 2. This raised to power 2. So what is the DCF for year 2? Someone should give me that. What is the DCF for year 2? 15%.
0.756.
Thank you, Esther. 0 point what?
756.
756. Right. It seems I have to change the person that will be giving me figure. Right. I have to switch. Esther. Olanike, you can hold on. Okay. Yeah, okay. When you multiply, what do you have?
960.0 960 no.
960. Good. Okay, so we have year 3. We have year 3. So year 3. Raised to power of 3. So what do we have here? What do I have?
0.658.
Okay, coming. 0.658. What do I have here?
896. 986, I mean to say.
986. Okay, that's fine. The fourth here. We have raised to power 4. Yeah, what do you have here?
Maybe 0.572.
0.572.
We have 1011.
Okay, I'm coming. Just a minute. 1011. Good. In the fifth year, this is 5. So what do we have here?
0.497.
497. Good. So what do you have here?
1037.
1037. Okay, class. According to the question, let's quickly go back and see where I pick all this from. The directors believe that the director believe that the free cash flow to equity will grow by 18% for the next 5 years. Right? You want to get the current value. What is the present value? That is why you are doing a valuation. Right? You grow down your equity by 18%. Then you discount it with what? With the cost of equity, because this is the free cash flow to equity. You can't use annuity figures for this. You can't use it. Right? You can't use it. It will not give you what you want, because the DCF are different, right? And again, what is it called? What is it called? There's a growth rate in what? In the 9125 on a yearly basis. How will you do that? So the best way to do it is for you to bring them out so that you understand what you are doing. Bring them out and do it this way, right? Now, and don't forget, there is 5% thereafter. This is it. So there is 5% what? Thereafter. Now, that 5% thereafter, I mentioned it that it is infinity, like, because the years was not stated. They said 5% day after till infinity. Please total this. What do you have? When you total this, what do you have?
4930.
Okay, 4930. Okay, you've treated the first part, class. This is the value. You've treated the first part. I didn't mean the question did not go further and talk about and 5% thereafter. You would have quoted that this is the current value of the company. You would have quoted that this is the what? The current value of the company. But the question still go further and say, and 5% thereafter. So after this, there is 5%. That is infinity. So when you see thereafter, it's infinity, because you don't know if it is. So they are telling you that the infinity will start from the last year, year 1, year 2 to year 5. So the infinity will start from that year 5 till infinity. We don't know the infinity, right? So therefore, you will say year 5 to infinity. Now, this is what you will do. Please, everybody should please pay attention to this part, right? It's very important. Don't forget, this is when you want to say 5% thereafter, you must start from the last year before you grow it thereafter to infinity. You must start from the last. Now, if you want to do what is it called? Forecast now, the previous forecast now. They will give you the previous information to forecast for the next information. I'm just using that as an example. So which means that when you say 5% thereafter, you have to start from the last year given to you, right? So in this case now, you just copy this and copy this to infinity, right? To infinity. They say it will increase by 5%. It will start from the last year. That is why I have to copy that part. Start from that last year times. It will increase by 5%. 5% is what? 1.05. Class. It will increase by what? 5%. Now, if this will increase by 5%, what will be the value coming? What will be the DCF that you will use? In this case, coming. So times what is the last year DCF? This is the last DCF because it is to infinity. You don't know the DCF. So you use the last year, which is the 5th year. You copy this 0. What 0. This. Now it is not. Now in this case, oh, sorry. Now the next thing is your cost of equity. Your cost of equity minus the growth rate. So this is the down formula class. Your cost of equity minus the what? Minus the growth rate. That is what you will use to divide. Your cost of equity minus the growth rate. The cost of equity is 15%, 0.15. Minus the growth rate is 5%, 0.05. Right? So this will give you the infinity. So this is what you will use anytime, any day. The question says, oh, so 5% thereafter, 10% thereafter. You don't need to stress yourself. First, when you say 5% thereafter, copy the last year figure, copy it out. This is it, right? Then grow it by that percentage. Then what is the DCF? Get the present value using the what? The last year DCF, which is 0.4. Now you divide it by what before you multiply? You divide it by the cost of equity minus the growth rate. This is how you will use. This is what you will use to calculate infinity at any time you want to. When we get to merger and acquisition, you will still see it. When we get to valuation of a business, you will still see it, right? So you have to master it now. So what do you have? Give me figure. First of all, multiply all this, divide it, and multiply by 0.4798. What do you have, class? Let me see.
10,889.
Do you approximate? Okay.
Yes.
1,000. Give me the figure.
10.
Okay, 10.
889. 889.
889. Okay, that's fine. Okay. You can complete, you can confirm this figure. So, what is the total value? Don't forget, the first question is 18%, which we get the value of this. The second one is 5% thereafter, which we get this. What is the total value of the business? Please add these two together. What do you have? What do you have? Market value. Pemisire. What do you have? Quickly. There is Esther.
15,819.
15,819.
819.
This is the total market value. This is the value of the business. This is the what? This is the value of the business. Total market value. How do we break this question down? We followed instruction. Now, what is the instruction given to us? The instruction says that the director believes that the free cash flow to equity will grow by 80 for the next 5 years. We'll grow it for the next 5 years. We discount it, we get the present value. Then the next one is 5% thereafter. That thereafter, you don't know the numbers of years. You don't know. That is why we call it 5 to infinity from the last year. And what will you do to do that? You can decide to pick this if I were you again, I can decide to pick this last present value, which is 1,037. I will grow it by 1.05. Okay, now, or alternatively, or, don't worry, or, let me, okay, or, sorry. So, I'll pick it from 1,037 times, I will grow it, because that is the last year present value, right? I will grow it by it will go by 5%. Then I will divide it. Then I will say divided by the cost of equity divided by the minus growth rate. That is what you will use, please. Anytime, any day. That is the formula. So you bring it up, right? So if you do it this way, what is the answer? Will you get the same answer? Do it, let's see. You get the same thing. Is it not the same thing, class? Class, is it not the same thing? Figure.
He's giving 10,889.
The same thing, right?
Yes, sir.
Yes.
Can you see it? Can you see that it's giving you the same thing? So whichever way you feel you will understand the infinity, use it and move on. Whichever way you feel you can use it to get 1,088, use it and you do what? To move on. But as far as I'm concerned, that is the formula. Which one did you want to do? You follow the question. Is that not so? You follow it. Pemisire. Pemisire. Okay. Mr.
Good
Victor.
evening and
Okay.
thank you for the lecture.
You're welcome.
Sorry, I'm lost. Oh, I'm lost when we got to that infinity source because what brings about the infinity calculation?
Okay. Have you been following?
Thank you.
Have you been following?
Yes,
You've
yes,
not.
yes.
You've been on and off. I've been seeing it. That's why. This is it. This is what brings about infinity. The first question says that this is it. We grow by 18% for the next 5 years. Can you see it? And by 5% thereafter. You don't know the thereafter. It is infinity because thereafter does not have
Okay,
limited. Like, do you get?
okay, okay, okay.
Do you get?
All right.
Mhm. Thank you. Mr. Victor,
Hmm. Hello, good evening, sir.
good evening.
Okay, my network has off break up, but I was understanding everything until the last point. So I know growing to infinity. I think is the same thing with perpetuity. Uh,
Mm.
as a this if we apply this perpetuity factor to find the cash flow, uh, value of the cash flow. Hello, sir.
I'm with you.
Hello, sir. What I'm apply the the perpetuity factor over R against the cash flow, meaning we have annual cash flow over R, where R is the rate of cost of capital of return. Um,
Um, uh,
but
Mr. Victor, I can't hear you.
my network is. But can you hear me now?
Yes, I can hear you now.
Okay, I'm asking if you apply the same perpetuity factor at regular cash flow to infinity or to perpetuity, which is the cash flow at this time, which we calculated 1037, or at this point where we have 912 times 1.1 raised to 8, whichever is the cash flow, and we divide by the cost of capital are we going to get the same value? I'm thinking in the line of for it to be simple for me, if I use the factor.
So go and check maybe on your own personal study. If you check if it gives you, fine. As far as I'm concerned, this is the best method. I think I will not say it's the best method. That is the best method. That is the method I understand to infinity, right? I can understand you that okay, you can use perpetuity. I don't want to go to all those kind of formulas so that it will not look complex, right? So that is why I say, oh, let me just do it this way, right? The first one is so that we will not confuse ourselves. The first one is we grow it by 18% to get the growth rate. So the perpetuity, the infinity till forever, right? We don't have the formula. Just pick the last present value. Grow it by what they gave you. Divide it by cost of equity minus growth rate. You are good to go, and we just move on from there. Mr.
But
Victor,
what do we need to minus by
that
the
is the formula.
uh, cost of it
Yes.
minus the growth rate?
Yes, minus the growth rate.
Okay, thank you.
There. Thank you. Any other question? Can we move? Okay. Now the question says that, Mr. Victor, are we good now? Are we on the same page?
Yes, please. Yes, sir. Thank you.
Okay. That's fine. Okay. That's fine. That's fine. So we are good. We are good, right? We are good. So now the question, this is the market value. This is the current value of it. But the question says that the current value per share. Now, what this indicates is that we need to divide it by the numbers of shares. And the numbers of shares is given to us as 600 million shares in issue. So we divide the total current value, divided by the numbers of shares so that you get what? The current value per share class. So you get what? The current value what? Per share. Sometimes it may be given in your statement of under your ordinary shares. Sometimes it may be given under your ordinary share, but in this question, we're given that the company current has 600 million shares in issue, right? And the question says, calculate the current value per share. Now, we've gotten the total market value. Is that not so? So, current market value per share is equals to total market value divided by total market value divided by the numbers of shares divided by the numbers of shares. Numbers of shares. So therefore, okay, we can pick it up from there, right? So divided by the numbers of shares. So this is 15. Is a million, right? 819 million divided by 600 shares. So what do we have? Divide it. What do you have? Quickly, so we can move ahead, please. 600 million shares. So when you divide it, what do you have? Hello, class.
26.
26 naira per shares, not 26. You divide it, you have 26 naira per what? Per shares, Esther. So equals to 26 naira because they say current value per shares. Per shares. So which means that when you go to, if they want to list this company in the stock market, they will list it as 26. If they are introducing it to the market, they will list it as what? 26 naira per shares. That is why you will see that they will say, oh, Dangote refinery shares in the NGS, currently they just list it and it is going for 20 naira per shares. They've done the valuation. They've done the valuation. That 26 naira that you see they push to the NGS, right, at the first time of coming into the market, right, was arrived in what? In valuation of the business, right? That 26 naira per shares, it is not just an ordinary 26 naira per shares. There is a lot that have been done underground, right? Maybe they use free cash flow to equity. They want to know what investor we get, because every investor is always inquisitive to get their return on their on their investment, either through the share price growth or through the dividend, right? I know many of you in this class may be an investor who always wants dividend. Some, it depends on your preference, right? Some may say, oh, I want, what is it called? Capital appreciation, which is increase in the market price, right? On this note, this is the end of this question. Class, are we still together? Are we together, please?
Yes,
Is
sir.
this not simple? It's simple, right? You will see more of this. You will see more of this. What we just did here, you will see more. This there after increase, you will see more of this when we get to. Sometimes it may be even be dividend. They may tell you that it is even the dividend that increase. The dividend will grow by 5% and 10% thereafter. This is what you will use to solve it. If they say dividend will grow by 10%, use the cost of equity to discount it, and 20% thereafter. Look for the infinity. Get the market value, get the current market value of the dividend, put it there, you move on. This is what you need to do, right? And that is it. Benjamin, before we move on, quickly, please.
Okay, thank you very much. Mine is just an observation. These figures under present value, I discovered when approximating, we approximated them to the nearest whole number. But the discount factor, we approximated them to 3 decimal places. So I don't know, is it right? I just want to reconfirm.
Yeah, it's right. It's right. The DCF
Okay,
3 decimal. The other one, just leave it as whole number then. You move on.
okay,
Right.
okay, all right.
Mr. Samson, the powerful. Are you still on this? Are you still with us or against us? Okay, I think that's all about this question, right? Can we move on, please? Are we tired? Do we still have the energy? Okay, your mic. Okay. Okay, exclusive, quickly. Exclusive, we need to move on, please. Quickly, exclusive. Mute your mic, quickly.
Sir, please, is this still not 2.6 kobo?
I don't know. It's the figure they gave me now. 15,818 divided by 600 million. 600 million. What do you
And
have?
this
26 naira is
2.6,
correct.
26
26
what?
naira. 26 naira is correct.
Per shares.
15,819. 15,819,000 E3
So you can confirm that, right?
over
Confirm it.
600 E6. No, this is not 26 kobo. This is not 26 naira per share. Even if you convert, if you do 26 naira per share times for 600 million shares, it won't give it. It's not.
Exclusive. Do 15,818 divided by 600. What do you have? 15,818 divided by 600. What do you have?
15,818 over 600. 26.
26.
No, I'm looking at, is it 600? It's not 600 million shares.
Uh,
I don't,
Exclusive.
well, maybe because I can't see the
You have
question.
already put million here. This 15,819 is a million. Is million. Is million.
Okay. That's like 15 billion naira.
Exclusive. Kai.
No. You
Exclusive.
know, I can't see the number. I can't see where we got the
Okay.
number of shares. You understand?
You,
So I'm trying
you can't see
to.
what?
I'm using the all the figures for my own calculation. I'm not using zeros.
Okay. Okay, please, let's move on, please. Let's move on. We are suspending all the questions. So we are done with this so that we can move on, please. Benjamin, keep your question. What is that? What's that? Quickly.
That these infinity figures we calculated, was it actually part of the requirements? I just want to know.
Oh, okay.
That's
Let
just
me
for
go back. Let
example.
me go back.
I don't need
Go
to
back.
be
Before, see, wait. You want to determine the current value. Current value means the present value, the market value of the shares, the market value of the company shares. How will you determine the market value of the company shares? You already gotten the what? The free cash flow to equity. This is not discounted. What will be the value, the present value, the market value of it? Now, go back to this question where they said the directors believe that the free cash flow to equity will grow by this, and that is why we have to do it like that, right? If this is not there, we just send it out. They will not even tell you to calculate the current value. They will just tell you calculate the free cash flow to the equity. Then you leave it and move on. Do you get that?
Yeah, it's fine. Thank you.
Okay. Now, uh, okay, we need to move on. Okay, sorry. Benjamin.
Yes, sir.
Okay, I will be calling you Dr. Benjamin. Don't worry.
No,
I'll add doctor
just
to your name.
Benjamin is okay, sir. I never get doctor. My pass I can first.
They play. Okay. I think we just need to continue our lecture, right? I will be introducing you to business. I will be introducing you to business valuation of a business. Please pay attention as we want to start new topic under the valuation. It is not a new topic like that, but it is still or is still under valuation of a business. Don't forget, free cash flow is a method of valuation of a business. Merger and acquisition is a method of valuation of a business. Economic value added is a method of valuation of a business. Shareholder value analysis is a method of valuation of a business, right? They are so many valuation of a business, right? So please pay attention as we want to go into valuation, business valuation. Now, class, this is valuation, valuation. The question is, why do you have to carry out valuation? I work in a real estate firm and I am not a surveyor, and I see surveyors, they will go and do valuation of inventory, valuation of an asset, right? A lot of valuations. And the question now is, when surveyors are talking, I will also talk in my own parts that to some extent, I understand valuation of a business. But guess what? The way they value their own assets is different from ours. We may be we will be looking at it the in the point of financial analyst or investment analyst. We'll be looking at it in shares perspective, right? Why surveyors will be looking at it that this is not a share perspective. We want to know the value of the asset, right? The current value of the asset, right? What is the current value of the inventory, right? But we will be looking at it that, okay, if I want to buy these shares, what will be the value? If I buy these shares, what will be the value? Now, why do you have to carry out a valuation of a business? Because you want to know the current value of the business, right? Business valuation, business valuation. What did you want to achieve? You want to calculate what? You want to get the current value of the business to enable you to make a decision, right? You want to do what? Get the current value. What will be the value of this business? If I say, okay, I want to buy shares now, you can't just go to the market. That is what we will do. What's next after ICAM? And that is what makes us different from others. We are next gen professionals, right? What's next? You can't just go to the market because your friend says, if if you've been following our lectures, go and check portfolio theory. There's one scenario I analyze in that portfolio theory. Go and check it. See, check that question. It's very important, please. Now, because your friend buy one of the bank shares, you quickly go there and buy the shares without knowing, without doing any analysis. At the end of the day, in the investment may go bad or good, right? You blame your friend. Is that not so? Without, what will be the value, right? What bring about valuation of a business? Valuation of a business will start from financial modeling, right? You do your 3 step. From your 3 step from financial modeling to valuation. What do you want to achieve? You want to know, should I buy this company shares? Or should I still have shares there? Should I sell it? And that is what will take us to what we call in valuation upside potential. Upside potential means that, oh, you have an upside potential of 50%. We look at it, I need to go and purchase more of this company shares because it is highly probable that if there is no any macroeconomic factor on the long run, it is highly probable that my shares will increase by what? We increase by um we will increase by what is it called? We increase by that 50%, right? Class. Now, the business valuation is to determine the value of the business, either through merger and acquisition, right? We'll get there. Now, don't forget, the purpose of business valuation is to determine the value of the business, right? Now, we have the reasons or the purpose of valuation of the business. The question is, why did you do valuation, right? It will enable you to make an investment decision. You want to buy shares or you want to sell shares for tax purposes. You want to know, is this company owing tax or not? For divorce settlements, you want everybody should go on its own. You don't want to do business again. Everybody should go. What will be the value of the business? For the disposal of subsidiaries, don't forget, MBO, don't forget, there is what we call divestment. In forecast, we mention divestment. Who can remind me, what is divestment? And what are the forms of divestment? I made mention of all these things in forecast. Who can remind me? Hello? Hello? Chai, let me see. Divestment.
Yeah. Yes, I'm here.
Okay. Can you remind me? I made mention of divestment, you know, in forecast. that B part of the question that they say, okay, they made mention of divestment. They talk about management buyout and management buy-in, right? Exclusive.
Huh?
What is divestment?
Divestment
Yes.
is just a way of probably investing in another business or splitting the business. Could be to split the business or to form a maybe the conglomerate is too big or something, so they want to
Okay,
split it.
that's fine. That's fine. So there is what? For the disposal of subsidiary, maybe this disposal, maybe the subsidiary is not performing well, right? You can decide that you dispose it out, right? And that is what we call, that is management buyout. There is management buy-in, there is management buyout, right? Now, now, management buyout means that you sell to who? You sell to the external purchaser, you sell it out, you don't want it, right? Because the subsidiary is not actually what? Is not performing well, right? Another thing is that to establish merger or takeover, don't forget, why do you do a valuation? The reason why you do a valuation is to determine either you want to match with this company or you want to either merger or acquisition, right? You want to merge with this company, you need to know the current value, right? And that will take us to what we call synergy in merger and acquisition. We'll get there. The reason why you need to do a valuation is to value shares sold in a private company. But the question is, a company that is not listed in the Nigerian stock exchange market, how do you determine the value of the shares? Interesting. So how do we do that? You cannot check NGS today and see the company name for you to know the current market price of that company. It is a private company. How will you do that? We will get there. So the question may ask you the function. You may be told to say to highlight the reasons for valuation of a business, and these are the reasons for valuation of a business, right? If that is established, we will move to the methods of valuation class. We will move to where? The methods of valuation. Now, I'm sure you are with your pen. In my notes, I will not write these advantages and disadvantages of, the way I teach, I tutor, right? I will not write it in that note. I'm sure you are with your pen, right? You are with your writing material. Then you can write, or you go back to the YouTube and watch it again so that you can jot down something, right? Now, I'll be explaining some things here that it is usually examinable, right? Now, asset-based method. Asset-based method. Now, a company can decide to use assets-based method to value its business, right? Or you can decide to use income-based approach. There is another method, dividend valuation method. You can use enterprise value multiplier effect and all those parts, right? But I can don't test that part. Where I can test most is the asset base, the income approach, the dividend valuation, as well as the free cash flow part of it. Don't forget, free cash flow is the method of valuation of a business class. Of a what? Of a business. Now, asset-based method. Under the asset-based method, there are three methods under the asset-based method, namely historical cost method, realizable or liquidation value method, and replacement cost method. Now, let me take it one after the other. Historical cost. Historical cost means that you are valuing the asset based on the previous cost of the asset. You buy an asset. Rachel, are you still on this in this class? Rachel, okay, that's fine. That's fine. You buy the assets January, let's say January this year or 2024, or no, let's say 2020. You want to do a valuation. You value it based on the amount you bought the asset in 2022, in that 2022. And what does that tells you? That it will never show an appropriate method of valuation. No, because it is an historical method of valuation. It does not consider, one of the disadvantages is that it does not consider the time value of money. How? You want to value my property now. You are telling me that the total cost I incur in 2022 to build up this property, to furnish it and everything is 100,000. Then you want to value it in 2027. You are telling me that it is that historical cost. It does not include the time value of money. It is not an appropriate method to be used in what? In valuing what? In valuing business, which is the historical cost. I've mentioned the disadvantage, right? It is always disadvantage because it is not normal. Now, realizable liquidation method. Realizable class. Realizable means that when you sell these assets, of course, Benjamin have an asset worth 20,000. Don't let me use Benjamin. AA Limited have an asset worth 20,000 class. Now, they need to finance the business. There is not enough money to finance the business. They go to the market. What is the realizable value? Why do you have to use realizable value instead of the historical cost? Why? Because you want to liquidate the business, right? During liquidation, the value of the asset is this, or what we realize in selling this asset is this, because we want to pay our debtors, because we have an obligations with them. So in every question, you will be told that, oh, the realizable value of this asset is this. And check the required. You will see it will be mentioned that you should use realizable value method under the asset-based method. Sometimes they will just tell you asset-based, but when you read the required and you read asset-based, when you read the additional information, you will see that, oh, the only method you can use here is historical or realizable or replacement cost. Now, realizable value as well does not give an appropriate method of valuation of a business because you are in distress. They call surveyors call something, they call when they want to force to sale. That is what they call it, right? Surveyors, right? Now, because it's in distress, you can't get the real cost of that. What? You can't get the real value of that asset class. You can get it. So it is, you can't even use it as a basis of valuation. The next one is what? The replacement cost. What is it? How much is it? You go to the market, you have to replace this. What is the replacement cost? Is this amount? Then you value it based on the replacement cost. If it is you own a business, or you have a business and you want to merge with A, why am I using merger? Oh, you have a business, let me use it. You want to merge with B. You now say, okay, let's say you want to take over B, right? Now, B will tell you that you can't use replacement cost to value my business. How? How? You see, set base will always give the lowest current value of an or current value of an asset. It will always give lowest current value. It will always value it at a lower price. Why? Because it does not consider cash flow. It does not consider the time value of money. And it is subjective. Class, am I communicating? Should, in case the question will tell you, explain the method you use in A, you will be the one to explain it for the examiner. Now, another thing is, class, are we tired? Everybody just class, hello. Are we still together? Okay. Okay, since the class is boring, right? Valuation is 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 one of my best topic in SFM, right? Because it is practicable, right? And when you understand it, you understand it.
Together.
Thank you, bro. Thank you. Now, if you want to determine the value, don't forget the purpose. Why do you value business? You want to determine the market price, the market value. If I say market price, it means per shares. If you go to the NGS, you have 2 naira per share, 24 naira. That is the market price. When you multiply it with the volume traded today, we give you the market value of that business. Class. We give you the value, market value of that business. So if you want to determine the market price, the value using the asset-based method, which any method under the asset-based, if you want to determine the value, the market price means per shares. If you want to determine the market value or market price of it, the purpose of it is to determine the market price of a business. Market price is equals to the total assets minus total liabilities divided by the numbers of shares. Don't forget, your total asset minus total liability will give you net assets divided by the numbers of shares. Your ordinary share capital, we have what? You have the market price. So when you want to get the value, you multiply it by the numbers of shares. You have your market value of the shares. You have your what? Your market value. Class. When you already gotten your market price, if you want to get the value, if the question says what will be the current value or the market price, if it is only market price, get the per shares. If it is value, what you have 2 naira per shares, per shares. Multiply by the numbers of shares, you have the total market value of that company, of that firm. Right? Next method. If you want to get the numbers of shares, the ordinary share capital divided by the nominal price or the nominal value. Ordinary share capital is 600,000, for instance. The nominal price is 1 naira. Divide it, you have your numbers of shares. Class. So in a nutshell, asset-based method will not give an appropriate value of a business because it is what? It is historical. It does not what consider the time value of money, right? It does not what and it is actually subjective, right? Take note of that. Income-based approach. Another method of valuation is income-based approach. What is income-based approach? A company, don't forget, a company that is listed in the NGS, Nigerian Stock Exchange market, you want to determine the value, the market price, class. Don't forget, it is all market price you want to determine, because you want to determine the market price that you will pay for that business or that will make you to invest in that business. That is what you want to do. And that is why one of the purpose of valuation to buy shares, right? What will be the market price? So the income-based approach make use of accounting profits. And guess what? Accounting profit, one of the disadvantages, accounting profit is subjective. Right? Accounting profit is subjective. Income-based approach does not consider the time value of money. Disadvantage. So when the question tell you, okay, I'm explaining to you, I hope you are taking note of all these things, because like now, me, I don't even forget. So valuation is, I like valuation because it is practicable. Like you can just listen to this class and understand valuation of a business, right? Even in practice. Now, under the income-based approach, we have the price earning ratio. Don't forget, class, when you want to determine the market price under the asset-based, it is total asset minus total liability divided by the numbers of shares. We give you the market price. Under the income-based approach, there are three methods under the income-based approach. First, the price earning ratio, right? 3 minutes. Okay. So, income-based approach is subjective because it makes use of accounting profits, right? And it does not what? Include cash flow. It does not consider cash flow. And that is the disadvantages of this method, right? Now, under the income-based approach, we have the price earning ratio. The formula is, don't forget, the objective is to get the market price. So the price earning ratio is equals to the market price divided by earnings per share. So when you make market price the subject of the formula, you will have market price equals to the price earning ratio times earnings per share, class. So that will give you the what? The market price per share. The price earning ratio times the earning per share. Look at the formula we use. You can see the formula that we use to get that, which is the price earning ratio. Now, the question is, how will you determine your earnings per share? It is calculated as earning per share equals to the profit after tax minus preference dividend, of course, divided by the what? The numbers of shares. The profit after tax minus preference dividend divided by the numbers of shares. That will give you earnings per share, class. Sometimes earning per share will not be given to you. You need to determine the earning per share for you to get the market price. Then if you want to get the market value, you multiply it by the numbers of shares, class. Market price means 1 per shares. This is what you have. If you want to get the value, multiply it by the numbers of shares, will give you the value of that company. Right? Now, under the income-based approach, there is what? Earnings yield. Don't forget, all these are accounting profits. Right? Right? They are what? Accounting profit. Earnings yield equals to earnings per share divided by the market price. You still make this the subject of the formula. I purposely bring this so that when the question says using the income-based approach, of course, it will be mentioned that it is price earning ratio or earnings yield. So if they say, oh, price earning ratio, we already know that, oh, price earning ratio, it is market price equals to the price earning ratio times earnings per share. We give you the market price. But if the question says earnings yield, you already know that, oh, earnings yield, you have to earnings yield, earnings yield equals to earnings means earnings by shares. This earnings is not correct. So is it correct? Please, is this spelling correct? Earnings, okay, check it. Earnings yield, right? Thank you. Equals to earnings per shares. Earnings per shares. Because it is earnings yield. Yield, market price. So even without this, I can bring out the formula. Earnings means earnings per share. Yield means market price. So you still make it the subject of the formula. You will have your market price equals to earnings per share divided by what? The earnings yield. Definitely, your earnings yield will be given to you in the question. Likewise, your price earning ratio here will be given to you in the question, right? Now, I need to mention something here again under the price earning ratio. Sometimes you want to calculate for price earning ratio for 2024. Let's say you want to value a business for the year 2024. They may give you price earning ratio for 2025, 2023, 2022, 2021, 2020. That is 4 years price earning ratio. Then you will now ask yourself which one of these price earning ratio you will use. What you need to do is that you used to look for the average price earning ratio. Average. You add all the price earning ratios together, divide it by the numbers of years. You look for the average. That average will be your price earning ratio, to be average price earning ratio that you will use to multiply your earnings per share. Please take note of that. Next is earnings yield. So the market price equals to earnings per share divided by the earnings what? Earnings yield. Can you see it? Right. Now, another thing is dividend yield. Dividend yield is not even common. Most times, I can we ask the price earning ratio. Most times, it is price earning ratio. All right. Before we go to the other methods, before we go, right? Before we go, the yield means market price. Dividend per share. Don't forget, just like earnings per share. So dividend yield, the formula. Class, all these things are investment ratio. I will not take ratio. So you'll be the one to go and do ratio analysis yourself. And these are all investment what? Ratio. Right? Investment what? Ratio. Dividend yield. Dividend yield is what? Dividend per share divided by the market price. How will you determine dividend per share? You want to pay total dividend of 50,000. What is the numbers of shares? 50,000 divided by the numbers of shares will give you dividend per share, right? Divided by the market. So the market price equals to, if you now make market price, don't forget the objective is to get market price, the current market price. Then if you want to get the value, multiply it by the numbers of shares, you get the market value of the company, the value of the company, class. So that is that method, right? So as I promised, I think I said we should just finish this income based approach, right? So in our next class, we'll look at the dividend valuation method. We've already talked about the free cash flow already in our previous lecture. We'll look at the dividend valuation method, the free cash flow. These other methods are not too common, right? These other methods are not too common. We just mention it. These others, right? As a form of valuation, they are not too common, right? I can don't set questions on all those parts, right? So the most important place that I can set questions is the asset-based method the income-based approach, as well as the future cash flow, the present future cash flow, which means that the present future cash flow could be either free cash flow to the equity or free cash flow to the firm. And that is why I said these are also the forms of what the valuation of a business. The purpose is to get the current value of the what of the business so that you will use it to do what to make a decision. Either you buy or you sell this particular share. If you want to do under the merger and acquisition, you look at it, okay, should we merge with this? What is their current value? What is their current value? Because that is why we have what we call revenue synergy, cost synergy, right? Revenue synergy and cost synergy under the merger and acquisition. We'll get there, right? So, distinguished professional colleagues, I think I've been able to do justice to valuation of a business to some extent. If you have questions, you can meet your mic and what and ask your question before we go. Finally, please, if you have question before you go, if you have question, meet your mic and ask your question.